let's say that I'm just somebody that's listening to the show. I'm interested in rental properties. I have yet to take the leap and invest in Jacksonville so far, right? But I am interested in knowing how I'm gonna, put this stuff together. What should I be kind of like preparing for, looking forward to, so that by the end of this year, I'm like nice and buttoned up and I know that I'm gonna benefit from this. Or if I'm somebody that's about to buy like a rental property, what will I for sure be wanting to ask my property manager if they are providing me, kind of thing?
Well, let's start with that. Let's assume that you're working with a property management company, because you can do all of this if you are not working with a property management company, and if you are doing your own taxes, if you have one property or maybe two or three. But, for so many reasons, if you are looking at single family rental properties as being a part of your financial portfolio, you should start to look for that team first, who's going to support your portfolio. If it's going to be 3 properties, 5 properties, 10, 20, 100 properties, it only makes sense. Because if you're working with the right team, they should have all of this buttoned up for you. All of the expenses that happen for your property should be tracked. There should be clear reporting. And so if you're thinking about what questions should you ask if you're thinking about getting into rental properties, when you're investigating the team to support you, the property management team, ask them about this. Ask them about their reporting. Ask them about how easy it is for you to file your taxes. And the answer should be, it's incredibly easy. So for example, JWB, we prepare what's called a Schedule E, right? A Schedule E is what you hand to your CPA, or you can do it yourself to do your taxes, and it lists out all the expenses for your rental property in the previous calendar year.
Okay, so those are all your expenses for the rental property for the previous calendar year. What about the depreciation side of it? Is there something that we need to do to prove like the depreciation, or is that just you got to give your CPA the original purchase price and they're going to be able to divide it by 27 or whatever?
So working with a CPA, it's clearly easier if you work with a CPA. You can do, you can claim the depreciation write-off if you don't work with a CPA. It's also very easy, but if you are working with a CPA, quite honestly, this is like accounting 101. It's like taxes 101 is doing what I just described, which is straight line depreciation. So even if you don't ask your CPA, I would be shocked if they don't do this right off the bat. Like I said, it's kind of standard operating procedure, but it'd be a great question to ask. So you can start to get into some more detailed questions when we get into other types of depreciation. Many times folks will say, well, can I get more depreciation if I do this? Can I do more depreciation if I have the size of this portfolio, if it's this type of asset? So those are great questions to ask your CPA. But as far as just taking advantage of everything that we're talking about right here, if you have a CPA and they're not doing this for you, you should absolutely find a CPA if you have to ask this question.
Got you. All right, cool. In the past, so these are all non-time sensitive, right? Like this is what, as an investor, if you're looking to get into tax advantageous assets, this is what you have to look forward to in rental properties because it has all these things versus others. I believe that in the past, we've talked about the idea that if you get in, like if I get in on like November or December 31st, I still get to take full depreciation from the full year of 2023. Is that true, or is that prorated?
So there's a lot of misconceptions. It's like, I think most people know that CPAs love rental properties for write-offs, but not everybody understands why. And a lot of us hear, oh, I should buy rental properties before the end of the year because of this. And there's some misconceptions when it comes to that. The way that it actually works is your write-offs are based on the amount of time that you owned that property in that year. So if you bought the property 50% of the way through the year, when it comes to your depreciation write-off, you're going to get 50% of the write-off. And so there's some misconceptions. Is there a huge reason to buy rental properties before the end of the year, by December 31st of this year, in order to get normal depreciation and all that? Well, if I'm being honest, not exactly, right? If you close it on December 31st, you're going to get 1 day prorated depreciation for the calendar year of 2023. But with that being said, there is always a really good time to buy rental properties because these write-offs will help offset other passive gains. And it's not just the gains that come from your rental property. If you have other passive gains from other rental properties, maybe you have a portfolio of properties and some of them are owned in cash or some of them have been owned for 5 years. You probably have significant gains. And so your depreciation on your one rental property can offset those gains. You can also be an owner, a passive owner of a business, and potentially use your rental property depreciation to offset those gains. You might be an owner of a McDonald's franchise, and you might sell those franchises or have significant income that's coming in. So, it's not necessarily for most write-offs that I'm talking about, this huge rush to do it by the end of the year in order to get more of an advantage. It's not like you get all of the write-off or depreciation if you close before the end of the year, or all of the closing costs. That's another one that's sort of misunderstood. You don't get to write off all of the closing costs if you close by the end of the year. But there is one little thing that we're going to talk about, which is super time sensitive. We haven't gotten there, but generally speaking, there's not a huge rush. It's not like you're going to get 10x the write-off for things like depreciation, closing costs, or any of the other write-offs that I've described. They're prorated.
Got it. So none of this stuff is phenomenally time sensitive, but you just teased it, right? There is actually something this year that makes it particularly advantageous to close by the end of the year. Do tell.
Well, it is appropriately named bonus depreciation, which is perfect because if everybody knows how much I love depreciation, you can only imagine how much I love bonus depreciation. So bonus depreciation is something that is super time sensitive. And that's why Pablo and I decided to do this show today. It's because you have the ability now still to be able to put a property under contract, a single family rental property under contract, and you have a good shot of closing on that rental property before the end of the year. And bonus depreciation is absolutely time sensitive. If you close by the end of 12/31 of this year, December 31st, you will have more of a tax savings than you would if you close January 1st of next year.
Ooh, okay, bonus depreciation sounds awesome. So tell me more about that. What is this bonus depreciation, GC?
So now bonus depreciation is not something that is necessarily a new thing. It's been around since the early 2000s, I believe. But by way of the Trump tax cuts, it allowed for more aggressive bonus depreciation. And so anytime that I'm talking about depreciation from a tax perspective, or now bonus depreciation, you should equate that with more tax savings, more money in your pocket that you don't have to spend for the same amount of income that you earn. And so what bonus depreciation allows you to do is for assets that qualify, you're able to write off a lot more in year one than the normal depreciation schedule would allow. And so if you close on a rental property this year, or there are other assets that qualify for bonus depreciation, but if you close on those assets and they're in service by the end of the year, you get to write off 80% of the cost of that asset in the first year of ownership. And when you close on December 31st, that qualifies as 2023 as being your first year of ownership. If you wait until January 1st to close on that asset, you only get to write off 60% of the cost of that asset in year one, and that would be in 2024. So this can have a huge effect. This can put tens of thousands of dollars potentially in your pocket this year if you're able to take advantage of bonus depreciation. And of course, if you invest in a number of assets. So this is a real thing. It can definitely mean thousands to potentially tens of thousands of dollars for specifically rental property investors out there.